Welcome, everyone. I am excited to have you join me today. We are diving into a topic that can really improve your trading skills. We will learn how to read the volume indicator. The volume indicator is a key tool that can help traders confirm trends, spot reversals, and identify breakouts. By the time we finish, you will understand how to use the volume indicator to make better decisions when trading. Let us jump right in. Imagine being able to truly understand what drives market movements. What if you could gauge the excitement, the fear, or the hesitation of traders at a glance? This is where the volume indicator becomes a game changer. The volume indicator shows us how much of a stock or security is traded in a specific time period. It reveals the buying and selling activity going on at any given time, giving us a direct insight into market behavior. You may wonder why this is important. Well, volume is like the pulse of the market, and it tells us if traders are excited and involved or if they are hesitant. The more people trading, the stronger the price movement is likely to be. When volume is high, it shows that a lot of traders are involved, which makes any price movement more reliable. When volume is low, it suggests there is less interest and the price movement may be weak. Volume also plays a crucial role in understanding different ** chart patterns **, as it helps validate whether these patterns will lead to a continuation or a reversal. One common pattern is the ** ascending triangle **, which forms when the price creates a series of higher lows while facing resistance at a similar level. Typically, as the price approaches the resistance, volume decreases. However, when the price eventually breaks above the resistance level, there should be a significant surge in volume to confirm the breakout. This shows that the buyers have taken control and the uptrend is likely to continue. Without an increase in volume, the breakout may lack conviction, increasing the risk of a false breakout. Another key pattern to consider is the ** descending triangle **, which is characterized by lower highs converging towards a support level. Similar to ascending triangles, volume generally decreases during the formation of the pattern. When the price finally breaks below the support level, a surge in volume is crucial to confirm that the sellers are firmly in control. This pattern often signals the continuation of a downtrend, and volume helps to confirm the reliability of this move. The ** symmetrical triangle ** pattern is another chart pattern where volume is particularly important. In a symmetrical triangle, the price moves in a narrowing range, forming lower highs and higher lows, indicating market indecision. As the price approaches the apex of the triangle, volume typically decreases. When the price eventually breaks out of the pattern, whether to the upside or downside, a strong increase in volume confirms the direction of the breakout. If the volume remains low, traders should be cautious, as it might signal a lack of commitment and the potential for a false breakout. Another important chart pattern is the **, flag, and pennant **. Flags are rectangular patterns that represent consolidation after a strong price movement, while pennants are small symmetrical triangles that also indicate consolidation. During the formation of both flags and pennants, volume typically decreases. Once the consolidation phase ends, a strong breakout should be accompanied by a significant increase in volume, confirming the resumption of the previous trend. If the breakout lacks volume, there is a higher likelihood that the move may fail or reverse. The ** wedge patterns **, both ** rising wedge ** and ** falling wedge ** also have distinct relationships with volume. A rising wedge forms when the price makes higher highs and higher lows, but the range narrows, indicating potential weakness. Volume often decreases as the wedge forms, and when the price eventually breaks down below the support line, increased volume is necessary to confirm the breakdown. In contrast, a falling wedge occurs when the price makes lower highs and lower lows within a narrowing range. As the price breaks above the resistance, a spike in volume signals that the reversal is valid and that buyers are stepping back into the market. The ** head and shoulders * pattern is another common reversal pattern where volume provides crucial insight. During the formation of the left shoulder, volume tends to be higher, showing strong buying interest. However, during the head formation, volume usually starts to decrease, and by the time the right shoulder forms, volume tends to be even lower. This declining volume trend is an early warning sign that the uptrend is losing steam. When the price breaks below the neckline, a strong increase in volume confirms the reversal, indicating that sellers have gained control. For the ** double top ** and ** double bottom * patterns, volume also plays an essential role in identifying the strength of the reversal. In a double top, volume during the formation of the second peak is usually lower than during the first, which indicates that the upward momentum is fading. When the price breaks below the support level between the two peaks, an increase in volume confirms the bearish reversal. In a double bottom, volume often increases during the rise from the second bottom, signaling strong buying interest and confirming the potential for a bullish reversal. The ** rounding bottom * pattern is characterized by a gradual U-shaped price movement. During the bottoming phase, volume is typically low, reflecting a lack of interest. As the price begins to rise and volume steadily increases, it confirms that buyers are stepping back in, making the breakout from the rounding bottom more reliable. Lastly, the ** diamond top * pattern is a rare but powerful reversal pattern that resembles a diamond shape. During the left side of the diamond, volume is generally higher, but as the pattern forms and the range narrows, volume decreases. When the price eventually breaks down below the lower boundary of the diamond, a surge in volume confirms the bearish reversal and indicates that sellers are gaining control. Now, let us expand on some common chart patterns and how they relate to volume. Understanding chart patterns can provide even more context when analyzing volume. One of the most recognizable patterns is the ** head and shoulders * pattern. This pattern consists of three peaks where the middle one is the highest, resembling a head, with the other two being the shoulders. Volume plays a crucial role here. During the formation of the left shoulder, volume is usually high. When the head forms, volume tends to decrease, and during the formation of the right shoulder, volume is generally lower still. This declining volume trend is a warning that the trend is weakening and that a reversal might be on the way. Another important pattern to understand is the ** double top ** and ** double bottom **. A double top occurs when the price reaches a peak, falls, and then rises to a similar peak again before dropping. Volume is usually lower during the second peak, signaling that the upward momentum is fading. In the case of a double bottom, the price drops, rises, then drops again to a similar level before climbing. In this scenario, higher volume during the climb from the second bottom can signal that a reversal to an uptrend is underway. We also have ** triangles **, which come in three types: ascending, descending, and symmetrical. In an ascending triangle, the price makes higher lows while facing resistance at a similar level. Volume tends to decrease as the pattern forms, but when the price eventually breaks out above the resistance level, there is usually a surge in volume, confirming the breakout. In a descending triangle, the price makes lower highs while finding support at a similar level, with volume decreasing during formation. A strong increase in volume during the breakout to the downside confirms the move. Symmetrical triangles show indecision, with the price forming a series of lower highs and higher lows. As the price moves toward the apex of the triangle, volume often decreases, followed by a breakout with a volume surge, confirming the direction. Another common pattern is the asterisk, flag asterisk, or asterisk, pennant asterisk. Flags are formed after a strong price movement, either upward or downward, and represent a period of consolidation. During the formation of the flag, volume tends to decrease. A breakout from the flag pattern, accompanied by a volume increase, signals that the original trend is resuming. Pennants are similar but have converging trend lines, and the volume behavior is the same as with flags. Understanding how volume interacts with these chart patterns can greatly enhance your trading analysis. Volume confirms whether these patterns are likely to result in a continuation or a reversal, adding another layer of reliability to your decisions. So how do we read the volume indicator and make sense of it all? It is not too hard. Just pay attention to whether the volume is rising or falling along with the price. If volume rises while the price is moving, it means that the price trend is strong and supported by many people. This is a good sign. But if the volume starts to drop, it suggests that the price movement may be getting weaker. We also need to look for volume spikes. A volume spike is when there is suddenly a much higher volume than normal. This can mean several things. It might mean that a new trend is starting, or it could mean the end of a trend, or it might indicate a breakout. Keep a close eye on how the price moves when you see these spikes in volume. It often gives you clues about what might happen next. Volume is also very useful for confirming trends. If the price is rising and the volume is also rising, that is a good confirmation that the trend is strong and will probably continue. This is especially true in an uptrend. If the price is going up and the volume is growing, it means buyers are in control and we can expect the price to keep rising. In a downtrend, it works the same way. If the price is falling and volume is also increasing, it means sellers are in control and the trend will likely continue downward. But if the volume starts to fall during a trend, it might be telling us that the trend is losing strength. This could be a sign that the trend is about to reverse or that the market is going to enter a period of consolidation. Keep an eye out for those changes in volume because they can give you an early warning that something is about to change. Now, let us go deeper into how volume relates to specific chart patterns. One of the most well-known patterns is the asterisk cup and handle asterisk. This pattern resembles the shape of a teacup with a rounded bottom followed by a smaller consolidation that looks like a handle. Volume is crucial in identifying a strong cup and handle pattern. During the formation of the cup, volume typically decreases, showing that sellers are losing interest. As the handle forms, volume should remain lower, indicating consolidation. When the price breaks out above the handle, there should be a significant increase in volume to confirm the breakout. Without this volume spike, the breakout might not be reliable. Another pattern to consider is the rising wedge, and falling wedge, A rising wedge occurs when the price is making higher highs and higher lows, but the range is narrowing. Volume often decreases as the pattern develops, signaling that momentum is weakening. When the price eventually breaks below the support line of the wedge, increased volume confirms the validity of the breakdown. In the case of a falling wedge, the price makes lower highs and lower lows with the range narrowing, and volume typically decreases. A breakout to the upside, confirmed by a volume increase, is often a reliable signal of a trend reversal. We also have the rounding bottom pattern, which is a slow, gradual reversal that often takes time to form. During the bottoming phase, volume typically remains low, reflecting a lack of interest. As the price starts to rise, volume should steadily increase, confirming that buyers are stepping in. A strong volume increase near the breakout level provides additional confirmation that the rounding bottom is a true reversal pattern. The rectangle pattern, also known as a consolidation or range pattern, forms when the price moves between parallel support and resistance levels. Volume tends to fluctuate within the range, often decreasing as the pattern continues. When the price eventually breaks out of the rectangle, either to the upside or downside, an increase in volume is necessary to confirm the breakout. Without strong volume, the price could easily reverse and fall back into the previous range. Lastly, let us consider the diamond top pattern. This pattern resembles the shape of a diamond and often forms after a strong uptrend. Volume is typically higher during the formation of the left side of the diamond, then decreases as the pattern narrows, and increases again when the price breaks down below the lower boundary of the diamond. The increase in volume during the breakdown is crucial, as it confirms that sellers are gaining control and that a reversal is likely. Understanding how volume interacts with these chart patterns can give you more confidence in your trading decisions. Volume can validate whether a pattern is likely to lead to a continuation or a reversal, helping you identify higher probability trading opportunities. Another way volume is helpful is when you are trying to spot breakouts. A breakout happens when the price moves past an important level, like a support level or a resistance level. This is a big deal because it often means that the price is going to continue moving in that direction. However, it is important to note that not all breakouts are real. Sometimes a price will break past a level but quickly fall back into the previous range, and this is known as a false breakout. To improve your accuracy in identifying breakouts, you can use volume as a key signal. When a breakout occurs, if there is a significant increase in volume, it suggests that many traders are participating in the move, making it more likely that the breakout is real and will continue. High volume at the breakout point is a sign that the breakout is being supported by strong market interest and commitment. On the other hand, if the price breaks past a key level but volume remains low, this could be a warning sign. Low volume indicates that fewer traders are participating, making it more likely that the breakout might be false and that the price could reverse back into its previous range. Another useful technique is to look for a retest after the breakout. When the price breaks through a significant level and then returns to test that level again, the reaction during the retest can provide further confirmation. If volume picks up during the retest and the price moves away strongly, it can be an indication that the breakout is valid. If volume is weak during the retest, it suggests a lack of interest and the breakout may fail. It is also helpful to understand the concept of break out failure patterns such as the bull trap or bear trap A bull trap occurs when the price appears to break above resistance, but low volume indicates a lack of buyer commitment, and the price falls back below the level, trapping buyers who went long. A bear trap is the opposite, where a breakdown below support appears to occur, but insufficient selling volume leads to the price rebounding and trapping sellers. By paying attention to volume during these moves, you can avoid falling into these traps and make better informed trading decisions. Volume is also great for spotting reversals. Let us say the price has been going up for a while and then suddenly volume spikes. If the price also starts to stall or even drop, this could mean that a reversal is coming. It is like a warning that the buyers may be losing control and the sellers are stepping in. Let us also look at some specific reversal patterns and how volume plays a key role. One common reversal pattern is the head and shoulders pattern. As mentioned earlier, volume is usually highest during the formation of the left shoulder and begins to decrease as the head forms. During the right shoulder, volume tends to be even lower, signaling weakening momentum. When the price breaks below the neckline of the head and shoulders pattern, a strong increase in volume confirms the reversal, indicating that sellers are in control. Another important reversal pattern is the double top This pattern occurs when the price forms two consecutive peaks at approximately the same level, with a dip in between. During the formation of the second peak, volume often tends to be lower compared to the first peak, indicating waning buying interest. When the price drops below the support level created between the two peaks, a surge in volume can confirm that a bearish reversal is underway. Similarly, in the case of a double bottom volume is often higher during the rise from the second bottom, confirming that buying pressure is increasing and a bullish reversal is likely. The rounding top and rounding bottom patterns are also significant reversal patterns. A rounding top occurs when the price gradually peaks and then begins to decline, forming a rounded shape. Volume is typically high at the beginning of the rounding top, but it gradually diminishes as the price curves, signaling a weakening trend. As the price starts to fall and volume picks up, it indicates that sellers are gaining control. In the case of a rounding bottom, volume starts off low during the formation of the bottom and gradually increases as the price begins to rise, confirming a potential bullish reversal. Divergence is another key concept to understand. Divergence means that the price is moving in one direction while the volume is moving in the opposite direction. For example, if the price is going up but the volume is falling, it tells us that fewer traders are participating in that move. This often means that the trend is weakening and a reversal could be on the way. Divergence can also be seen in indicators such as the relative strength, index RSI, or moving average convergence, divergence, MACD**. When the price makes a new high but volume or these indicators do not confirm the strength, it is a signal that the trend may be losing momentum and a reversal could be imminent. There are also specific volume indicators that can help you go deeper in your analysis. One example is on balance volume. This indicator helps us see if the overall flow of volume is more on the buying or selling side. If the on-balance volume is rising, it means there is more buying pressure. If it is falling, there is more selling pressure. This can help us see if the big players are buying or selling. Another helpful volume indicator is the volume oscillator. This one shows if short-term volume is higher or lower compared to long-term volume, which can be useful for spotting changes in momentum. There is also the accumulation distribution line. This measures the buying or selling pressure in the market. If the price is going up but this line is falling, it could mean that a reversal is coming soon. Now let us talk about how you can use volume in your trading strategies. One simple strategy is called the trend following strategy. This means you follow the trend when the volume supports the price move. If the price is going up and volume is also increasing, it is a good time to buy. If the price is going down and volume is rising, it may be a good time to sell or even go short. Another effective strategy is the ** breakout strategy **. In this strategy, you enter a trade when the price breaks a key level of support or resistance, but only if the volume is high. High volume during a breakout indicates that many traders are supporting the move, which makes it more reliable. To be more thorough, always monitor volume leading up to the breakout point. A gradual increase in volume leading to the breakout level can often hint that a breakout is about to occur. After the price breaks out, a strong follow-through with even higher volume can confirm that the breakout is legitimate and not a false one. If you notice low volume at the breakout point, consider staying cautious, as it could lead to a ** false break out * and a quick reversal back to the previous trading range. The third strategy is the ** reversal strategy **. When you see divergence between price and volume, it is a clue that a reversal may be approaching. Divergence occurs when the price is moving in one direction, but volume is not supporting that movement. For instance, if the price continues to rise but volume decreases, it could be a sign that the current trend is weakening. Start looking for specific reversal patterns, such as the head and shoulders or double top patterns, combined with volume spikes to confirm a reversal. When volume spikes while the price begins to change direction, it may be a great opportunity to enter a trade early, positioning yourself before the larger trend shift happens. Another important strategy involves using volume in ** pullback trading **. In an established trend, pullbacks are common as the price temporarily moves against the trend before resuming. During a pullback in an uptrend, watch for volume to decrease, which indicates that the selling pressure is temporary and that the main trend may resume. When the price starts to move back up with increasing volume, it can signal an excellent buying opportunity. The same logic applies in a downtrend. If a pullback has low volume and the downtrend resumes with increasing volume, it could be a good time to sell or go short. Finally, there is the ** volume spike strategy **. A sudden surge in volume, known as a volume spike, can often precede significant price movements. Volume spikes can occur at key support or resistance levels, and may indicate a strong interest in the price at that point. If you see a volume spike at a resistance level and the price starts to fall, it could be a sign to short. Conversely, if you see a volume spike at a support level and the price starts to rise, it could be an excellent opportunity to buy. This strategy helps you capitalize on market turning points and capitalize on shifts in momentum. Volume is not only useful for identifying opportunities, it can also be helpful in managing your risk. Let us say the price breaks a support level on high volume. You could place your stop loss just below that level in case the price keeps moving against you. This helps protect your position if the trade goes wrong. You can also adjust how big or small your position is based on volume. If the volume is confirming the trend, you might want to increase your position size because the move is likely to be strong. If the volume is low or unclear, it is often wise to reduce your position size until things become clearer. Now let us talk about a few common mistakes that traders make when using volume. The first mistake is ignoring volume during breakouts. A lot of traders enter a breakout trade without looking at the volume. This can be risky because without volume, the breakout may not be real. Always check that volume is supporting the move before entering the trade. The second mistake is overreacting to low volume spikes. Not every volume spike is important, and it is crucial to distinguish between meaningful and meaningless spikes. Always look for confirmation from the price action. For instance, a sudden increase in volume without any significant change in price direction might not be worth reacting to. Just because volume spikes does not mean you should jump into a trade without analyzing what is happening with the price and checking for other signals of strength or weakness. The third mistake is failing to recognize the importance of volume during *** chart patterns ***. Many traders overlook how volume can validate or disprove chart patterns like head and shoulders, double tops, or triangles. For example, a double top pattern followed by low volume on the second peak is a signal that momentum is fading and a reversal could be likely. Understanding these nuances with chart patterns can greatly enhance the accuracy of your trades. Another mistake is not understanding ** divergence ** between volume and price. When volume diverges from price action, it can be a strong signal that the trend is weakening. For example, if the price is continuing to rise but volume is declining, it might indicate that fewer traders are involved and a reversal could be imminent. This divergence can often signal that it is time to be cautious rather than continuing to follow the current trend. Finally, do not rely on volume alone. Volume is powerful, but it is best used along with other indicators. Moving averages, trend lines, candlestick patterns, and momentum indicators can all help confirm what volume is telling you. For example, using volume in conjunction with ** relative strength index, RSI ** or ** moving average convergence divergence, MACD ** can provide stronger signals and reduce false positives. Combining volume with other tools will make your analyses stronger and help you avoid false signals. Speaking of combining volume with other indicators, let us look at a few ways to do that. Moving averages are great to use with volume. If the price crosses above a moving average and volume spikes, this is a strong signal to buy. The moving average shows you the trend, and the volume confirms it. The relative strength index is another useful tool. This indicator helps us see if something is overbought or oversold. If the relative strength index is showing that a security is overbought and the volume suddenly spikes, it might be time to look for a reversal. Bollinger Bands are another indicator that works well with volume. If the price breaks above or below the bands and the volume is high, it is a more reliable signal that the trend will continue. To recap, the volume indicator shows us how much trading is happening at any given time. Use rising volume to confirm trends, watch for volume spikes to identify possible reversals, and always look at volume during breakouts to see if the move is real. Start practicing with volume in your own analysis and keep an eye on those key price levels. Remember to use other indicators like moving averages or the relative strength index to help confirm what volume is telling you. The volume indicator is a powerful tool, and it is one that can help you make smarter trading decisions. Take your time to practice reading the volume indicator, refine your skills, and soon you will be able to read the market more confidently. If you have questions or want to share your thoughts, I would love to hear from you. Keep learning, stay curious, and happy trading.